Good evening and welcome to our market coverage. Let's start with the key closing numbers. The Nasdaq finished at 24,836.60, the S&P 500 at 7,165.08, and the Dow Jones at 49,230.71. The VIX closed at 18.71, the 10-year Treasury yield at 4.31%, and the dollar index at 98.51. The offshore yuan stood at 6.8346 against the dollar. Bitcoin was at $77,562.56, WTI crude at $94.40, and spot gold at $4,722.30. The strongest sector today was semiconductors, with the Philadelphia Semiconductor Index surging 4.32%. The weakest was healthcare, down about 1%. The overall market tone today can be described as a structural bull trap combined with extreme capital concentration. While the headline indexes hit new all-time highs, the underlying structure is fragile and far from a healthy broad-based rally. Capital has been siphoned aggressively into semiconductor stocks, primarily driven by AI narratives, while rotating out of defensive sectors. Asian markets were mixed. China's Chinext board came under pressure, but chip stocks rallied. Meanwhile, earlier high-flying themes like optical communications suffered heavy losses. European markets were a drag on global sentiment. The stock 600 closed lower, weighed down by a downgrade of Belgium's sovereign rating and renewed inflation concerns, offering no support to risk assets. The U.S. market was the main event. Intel's better-than-expected earnings report acted as the sole catalyst, pushing its shares up more than 20% and dragging the entire semiconductor sector along with the Nasdaq to record highs. But here is the danger sign. While the index hit a new peak, more than 60% of S&P 500 components were actually declining, and the Dow Jones finished in the red. Market breadth deteriorated sharply. Capital was pulled out of the rest of the market and funneled into a single hot spot. This kind of extreme concentration is often a precursor to a market top or sharp volatility. The market simply ignored multiple obvious negative signals including the poor breadth, the Dow's weakness, and Europe's macro troubles. This reflects a market that has become completely captured by a single AI narrative, with funds behaving in a highly uniform manner. Looking at the interplay between currencies, equities, and bonds, a weakening dollar and falling 2-year Treasury yields should have provided liquidity support for a broad rally. But instead, the equity market reaction was extremely narrow, with only tech stocks benefiting. The 10-year yield remained stable at 4.31, indicating that long-term inflation and growth expectations have not changed. This divergence has dual implications for Asian markets tomorrow. On one hand, the strength in U.S. tech will provide a positive open for semiconductor and AI-related stocks in Asia. On the other hand, the fragile internal structure of the U.S. market will suppress overall risk appetite. Investors should be wary of an open high and then decline pattern in Asian tech stocks. It is not advisable to chase highs. Instead, look for capital to potentially rotate into beaten-down defensive or oversold sectors. Semiconductors and AI hardware were the strongest direction today, while healthcare and other defensive sectors were the weakest. AI and semiconductors have formed a continuous main line for over 3 months, and Friday's performance represents an acceleration and extreme of this trend. For tomorrow's pre-market warning, Asian semiconductor and AI stocks are expected to open sharply higher, but the overall market may see a high open and then weaken. Defensive sectors like healthcare were oversold on Friday. If semiconductors see profit-taking early next week, capital may flow back into these oversold areas. Over the weekend, watch closely for any geopolitical rhetoric regarding U.S.-Iran relations or the Strait of Hormuz. If tensions escalate, it would quickly push oil prices higher and puncture the current fragile market sentiment driven by a single narrative. Let me give you the key conclusions. Friday's extreme market divergence is unsustainable. Investors should be cautious about a potential pullback. The recommended strategy is to hedge. While holding long positions in core tech stocks, consider buying put options on the Nasdaq or semiconductor index, or going long the VIX to hedge against the risk of a correction driven by deteriorating market structure. If on Monday the S&P 500 shows more advancing stocks than declining ones while the index continues to rise, that would indicate breadth is improving and the hedge thesis would be invalidated. Otherwise, remain cautious and wait for the market to self-correct. The probability of an upward move tomorrow is 25%, a sideways move 40%, and a downward move 35%. Stay tuned for our next update.